Hi, everyone. Welcome to my channel. Have you ever found yourself in a panic over the stock market crashing? You wake up on a Monday morning, and suddenly the news is full of doom and gloom. The Dow Index has dropped 1,000 points, and everyone's selling off their stocks. It's scary, right? Your mind races with thoughts of economic recession, rising unemployment, and losing your hard-earned money. But what if I told you there's a way to understand and manage these feelings? Today, we're going to dive deep into why we react this way and how we can keep our cool when the market goes haywire. We'll break it down with real-life examples and practical tips. So, let's jump in and learn how to stay calm and collected even when things look bleak. So, what really happens when the stock market crashes? On Monday morning, the Dow Index took a nosedive, dropping 1,000 points. Investors were in full-blown panic mode, selling off their stocks in a frenzy. But why do we react this way? It all boils down to psychology. When the market dips, people fear a recession. This fear triggers a panic sell-off. Most of us are naturally risk-averse. We'd rather avoid losing money than take a chance on making more. This means that when we hear bad news, we rush to sell our stocks to avoid potential losses. It's called loss aversion. We feel the pain of losing $1 much more intensely than the joy of gaining $1. This fear drives us to make rash decisions, leading to a market downturn. The media doesn't help either. Headlines scream about the market crash, and social media amplifies the fear. This creates a herd mentality. We see others selling, and we think we should too, even if it's not the best decision. This collective panic only makes things worse. Let's talk more about risk aversion. Most people hate losing money more than they love making it. This is why, when the market starts to drop, we panic. We want to protect what we have, so we sell off our stocks, hoping to avoid further losses. But this behavior can be irrational. Instead of waiting for the market to recover, we act on impulse. Then there's herd behavior. This is when we follow what everyone else is doing, often without thinking it through. If you see your friends selling their stocks, you might feel the urge to do the same, even if it's not the best move. This can lead to a domino effect, where everyone starts selling and the market crashes even more. The media plays a huge role in amplifying panic. News outlets know that bad news sells, so they often exaggerate the situation to attract viewers. This creates more fear and uncertainty. Social media adds fuel to the fire. When we see alarming posts and tweets, it triggers our anxiety, and we start to panic. This leads to more selling and a bigger market crash. But here's the thing. Market corrections are normal. The stock market goes through cycles of ups and downs. Even during a recession, it's important to stay calm and avoid making impulsive decisions based on fear. Focus on the long-term potential of the market. Remember, recessions are part of the economic cycle, and markets eventually recover and grow. So, how can we stay calm during a market crash? Here are some practical tips. 1. Stay informed, not overwhelmed. Keep up with the news, but don't let it consume you. Limit your exposure to sensational headlines and focus on reliable sources. 2. Stick to your plan. Have a long-term investment strategy and stick to it. Don't make rash decisions based on short-term market fluctuations. 3. Diversify your investments. Spread your investments across different assets to minimize risk. This way, if one market takes a hit, you won't lose everything. 4. Talk to a financial advisor. If you're feeling anxious, talk to a professional. They can provide guidance and help you make informed decisions. 5. Practice mindfulness. Techniques like deep breathing, meditation, and yoga can help you stay calm and focused during stressful times. Let's look at some real-life examples. During the 2008 financial crisis, many people panicked and sold off their stocks. But those who stayed calm and held on to their investments saw significant gains when the market recovered. Warren Buffett, one of the most successful investors, often says, "Be fearful when others are greedy and greedy when others are fearful." This means that staying calm and making rational decisions during a market downturn can pay off in the long run. It's also important to understand that the economy goes through cycles. Recessions happen, but so do recoveries. Instead of panicking, try to see the bigger picture. The market will eventually bounce back, and staying invested can lead to long-term gains. Accept that some level of risk is part of investing. If you're too risk-averse, it might be better to avoid the stock market altogether. But if you're in it for the long haul, stay confident and trust that the market will recover. Market crashes can be scary, but they don't have to be. By understanding the psychology behind our reactions, we can learn to stay calm and make better decisions. Remember, market corrections are normal, and the economy goes through cycles. Stay informed, stick to your plan, and don't let fear drive your decisions. With the right mindset, you can navigate the ups and downs of the stock market and come out stronger on the other side. Thanks for tuning in. If you found this video helpful, please like and subscribe for more content on managing stress and making smart financial decisions. Stay calm and stay invested.